This video is brought to you by the award-winning prop firm, TRADERZEN.
This is actually pretty interesting. I call it a buy the close rally. As soon as the bar closes, you know it's going to go, the market's going to try to go higher. So you just buy the market. So you buy at the close of the bar. If you prefer, you can buy with a stop order, one tick above the high of the bar. All right. So it's buy the close, 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 buy the close right here. All right. And it remains by the close until you see something disappointing. And if you bought this, what do you think once you see that? You're thinking, oh, it's disappointing. Maybe it's no longer going to be buy the close. Maybe it's better to be looking to buy pullbacks. Okay. So if you bought that close and then you see this, and now you're thinking the market might be changing. Instead of buying closes and being willing to buy at the top of a bull trend, maybe it's better to stop buying at the top of the trend and wait for pullbacks and then buy pullbacks. Okay. So you have a bunch of disappointed bulls here who bought the close here. And what are those bulls going to do? A lot of them are going to say, it's not doing what it was doing, and therefore I'm going to get out.
Yep.
So the bulls who bought that close placed limit orders to get out, break even. Yep. What happened on this bar?
The limit orders
went up to the entry price to these bulls, and they dumped.
Yep.
Right. And that's what created that tail. So you get disappointed bulls with this bar, dumping here with that tail testing that close. And the ones who didn't dump, they have a bear bar closing near its low. They dumped there. And smart bears understood that this is a sign of bulls giving up. And they also knew that this is a micro double top, up and down, up and down. And if they're super smart traders, they know this is an II pattern, and that in buy climaxes or in sell climaxes, it often leads to a reversal. So it's a really good stop entry sell below the low of that bear bar, or below this bar, which turns out to be the same.
All right, folks, here we are on Trading Nut. We've got Al Brooks in the house. It's been a long time. It's been 6 years, in fact, that he's been on the show. I can't believe it. Episode 40 of my 52 Traders podcast. And he is the #1 price action authority in the world. So glad to get you back on the show, Al.
Thank you, Cam. I'm very happy to be here.
And I think the first time we did it, we didn't even have videos going. So this is awesome. Al's going to share his chart, and what we're going to do is something a little bit different. We're basically going to go through the interview he did 6 years ago, where he had so much technical analysis stuff about reading price action in there, and try and get Al to demonstrate some of these concepts he talked about in the show during this screen sharing session. So Al, we're going to get you to share your screen, and then let's get on with it.
Okay, good deal.
TRADERZEN is an award-winning prop firm that funds traders with up to $2 million and offers generous profit splits up to 90%. So one thing that really sets TRADERZEN apart is their no minimum trading days requirement on their challenge and verification stages. On top of that, traders who successfully pass the challenge and verification stages are eligible to receive a bonus payout of up to $30K on top of their funded stage profit split payout on performance. And be sure to use promo code TradingNut, all one word, to get 10% off your next challenge. Click the link in the description below or the card above to find out more. So Al, to start off with, do you want to just first of all, over 6 years, I'm guessing stuff may have changed. So is there have you had any sort of revelations or changes in what you've been doing from the 6 years ago to now around reading a price chart?
Not really. I've been doing the same thing now for over 35 years, I guess 36, 37 years. And one of my fundamental beliefs is that charts are created by rational human behavior. It's done by algorithms, but it's all rational. And there are only so many rational things that you can do. And if you're a hedge fund consistently making money, you're going to be using a handful of tools over and over and over again. So you're going to be repeating what you're doing. And the result is the charts repeat what they're doing. There are some things that take place on the charts that are different from back in the 1980s, when most of the trading was, or all the trading was done in the pits. But it's still, they're still repeating patterns. I see them every day. I'm looking for them every day. I have them categorized. I have essentially 100 basic patterns, and then there's a bull and a bear version, and then there's a successful and a failed version. So I have about 400 patterns categorized in my encyclopedia. And every day I add charts. So for today, this is today's 5-minute E-mini chart. And we had a bull trend from the open. And then up here, I don't know if you can see it. This bar, the high is below that bar. This bar, the low is above that bar. So it's an inside bar. And then it's followed by a second inside bar. And whenever you have a buy climax or a sell climax, and then you get consecutive inside bars, I call it an II pattern, you often get a reversal, not just a minor reversal into a trading range, but a trend reversal. And that made this a very high probability sell. So we had that. And then we have a little wedge bear flag here, second leg down after a surprisingly strong leg. That makes sense. And then here, this is the opposite of that. This is an II pattern. And on a smaller time frame chart, it's a contracting triangle. And this is an expanding triangle. We have three lows, lower low, and a higher high. So this is an expanding triangle. This is a contracting triangle. This is a buy climax. We get a reversal down. This is a sell climax. We get a reversal up. So I'm just looking for this stuff all day long. On the open here, we had a bull inside bar closing near its high after a gap down. That is an okay buy. And then we have consecutive bull bars closing near their highs. That is a buy signal. And then here we have consecutive bull bars with one being a bigger body. And you have three consecutive bull bars closing above the midpoints. So that's a buy. And so there are buy signals all the way up. On the way down, we have consecutive bear bars, both big, at least one closing near its low. If you did not take that sell, you sell below that, or you certainly sell below that. And you can see everybody did. You can see there was a lot of selling after the consecutive bear bars closing near their lows. So, and then this reversal, I talked about it being a sell climax and an expanding triangle, but it's also a wedge bottom. We have three lows, 1, 2, and 3. And that's a common reversal pattern. Here we have a wedge rally, and then we get a bull breakout. That's a surprising thing. So you'd expect at least a small second leg up here. Here's a bigger second leg up. So even with the computers doing all of the trading, the patterns are the same. I think it's really important when you get trends that look like this to buy. If you don't take the first buy, you take the second buy. If you don't take the second, you take the third. If your stop is getting too far below, you have two choices. One is to say, I don't want to trade. And the other is to say, okay, I have two position sizes, my normal size and then a small size. And I'll take my small size. And I'm always telling people in my chat room that the small size, you should keep it simple. Don't have 5 different sizes, have 2 sizes, your regular size, and then a second size that's 20% as big as your first size. So if you normally trade 5 E-minis and the stop is too far, instead of thinking maybe I should trade 4 or 3, just always go to 20%, trade 1. And you can add on as the market goes your way.
It's interesting. I've quickly realized within about 20 seconds there that what you shared in the show is actually dwarfed by what you've just shared in the last 2 minutes. So I'm thinking that we're probably best just to dive into the detail around this. And I mean, from my point of view, I mean, there's so much in there. And I think a lot of people, newbies are probably going to be a little bit like overwhelmed, but people who are understand about reading price are going to find this very intriguing. Now, is this what have you just shown here? What's this? This
is today's chart. This is the chart for sure.
I thought it looked familiar.
Okay, it's that chart. And about 15 minutes before I started talking to you, I created, copied it and pasted it into PowerPoint. And there's an II, consecutive inside bars. There's another II. There's a small expanding triangle. There's another expanding triangle. And OO, consecutive outside bars, is the small expanding triangle on a smaller time frame chart. And then we have another one here. We have a wedge here, 1, 2, 3, look for a reversal. We have a wedge here, 1, 2, 3, look for a reversal. This is actually a micro wedge, up and then down to the close, up and down to the close and up. And if you looked at a smaller time frame chart, this would be a wedge. So you'd start thinking about at least a minor reversal, and then you add to it the II in a buy climax. You're looking for possibly a major reversal. So that's a reasonable swing short, betting that it could be the high of the day, which it turned out to be.
So if you were going to trade that chart today, maybe you did, where would be your entries, exits, and stops placed?
You have a gap down and a sell climax. It's a bear trap. Okay, big bear bar, everybody thinks it's going down. No, it's not. It's testing support or resistance. In this case, it's testing support. And what's the support? Well, the January high and the open of the week. And why does the January high matter? Well, look at the monthly chart down here. Okay, I'll do it over here. Okay, here's the monthly chart. We had a very strong rally after the pandemic, and then we've sold off in 3 legs: 1 bounce, 2 bounce, and 3. And then we had a really good reversal bar in October and a good entry bar. You'd expect a couple of legs sideways to up after a wedge, but we've had 1 pullback, and this is the start of 2. And January is a very good looking buy signal bar. So its high is really important, and we've been testing it. Okay, this blue line is January's high, all right? And the open of the week is always important because on the weekly chart, traders are always thinking, is the week going to have a bull body or a bear body? Is it going to have a big bull body or a big bear body? So you can see today, this open was a test of the open of the week and a test of the January high and a test of yesterday's low, the red line. And we quickly rallied above yesterday's high and the high from last week, one of the highs from last week. So important support here. And the gap down, test of support, tested it again a second time, tested it again a third time. And at some point, if the bears can't push through that support, they think, uh-oh, it's probably too low to be selling. So what do the bears do? They buy back their shorts. And the bulls see that the bears are unable to successfully push through support, and the bulls buy as well. So, the bears made 3 attempts, that a gap down, a very strong sell-off, a second really strong sell-off. At some point, if they're unable to drive the price down, they're going to stop selling. They're going to buy back their shorts and look to sell at a higher price. And pretty much they bought back the shorts and then really did not do much selling for the rest of the day. So in the open, I'm always looking for patterns. 90% of days will have at least 1 swing trade. And the swing trade would be about 40% of an average day's range. Let me pop open a PowerPoint. Okay, this is a lot of text, but basically every 90% of days will have at least 1 swing trade that is about 40% of an average day's range. So if the average range is 50 points, 40% is 20 points. That means 90% of days will have at least 1 trade that's good for 20 points with a good stop entry signal bar, either up or down. And here, we got 20 points here. Here, if you bought that, you got your 20 points. Here, if you sold that a couple of days ago, you had 20 points here, but it kept going down for 100 points. And today, this was a good candidate for a 20-point swing up. This is a good candidate for a 20-point swing down. So today we had 2 fairly easy 20-point swings. Early in the day, you know that there's a 90% chance there's going to be at least 1 swing of 20 points. Okay, you know that. So if you see context that is possible to be the start of a swing, and you see a good signal bar, you got to take it. All right. So you can either buy above that or buy above that, and then look to exit 20 points up. You can sell below this. If you want, you can scalp, but there's a reasonable chance you can get a swing. And once you see this, you really got to be swinging. That's pretty aggressive selling. And you got, much more than 20 points down.
Folks, I'm excited to tell you about my new sponsor, Black Bull Markets. They are based here in New Zealand, and they're a New Zealand regulated broker who offers up to 500 to 1 leverage and over 26,000 tradable instruments. You can trade Forex, shares, commodities, indices, crypto, and they're an award-winning brokerage firm here in Asia Pacific with dedicated 24/7 client support and no minimum deposit. To trade with Black Bull Markets today, click the link in the description below or in the card above. And so that first bar there, so you've seen that bear that's rejected, then you've got an inside bull with a small wick on the top. Did that give you enough confidence to get in at a stop order there, or were you looking at a limit order on that bar?
That's I think a really good stop entry buy. And then when you get 2 bull bars closing near their highs, that's another buy. When you start to get 3, 4, we ended up with I think 8 or 9. Every one of them is a buy. This one is a little bit bigger after a smaller one. So it's reaching. And when you have that and you're long and you have all this profit, a lot of bulls will take profits, and that's what created this. And this is actually pretty interesting. I call it a buy the close rally. As soon as the bar closes, it's going to go, the market's going to try to go higher. So you just buy the market. So you buy at the close of the bar. If you prefer, you can buy with a stop order, one tick above the high of the bar. All right. So it's buy the close, 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 buy the close right here. Right. And it remains by the close until you see something disappointing. And if you bought this, what do you think once you see that? You're thinking, it's disappointing. Maybe it's no longer going to be buy the close. Maybe it's better to be looking to buy pullbacks. Okay. So if you bought that close and then you see this, and now you're thinking the market might be changing. Instead of buying closes and being willing to buy at the top of a bull trend, maybe it's better to stop buying at the top of the trend and wait for pullbacks and then buy pullbacks. Okay. So you have a bunch of disappointed bulls here who bought the close here. And what are those bulls going to do? A lot of them are going to say, it's not doing what it was doing, and therefore I'm going to get out.
Yep.
So the bulls who bought that close placed limit orders to get out, break even. Yep. What happened on this bar?
The limit orders
went up to the entry price to these bulls, and they dumped.
Yep.
Right. And that's what created that tail. So you get disappointed bulls with this bar dumping here with that tail testing that close. And the ones who didn't dump, they have a bear bar closing near its low. They dumped there. And smart bears understood that this is a sign of bulls giving up. And they also knew that this is a micro double top, up and down, up and down. And if they're super smart traders, they know this is an II pattern, and that in buy climaxes or in sell climaxes, it often leads to a reversal. So it's a really good stop entry sell below the low of that bear bar, or below this bar, which turns out to be the same.
And how do you get that level of confidence that that is a strong reversal versus just something else? Is it just because you've seen it so many times and you're able to pull on that knowledge?
I've probably watched more movement, more price action than anybody on the planet. I've been doing, and I'm serious about that. In terms of on the 5-minute intraday chart, I've been doing this since 1987. So whatever, 36 years. And there are 81 bars a day, and there are 220 days a year. And when you multiply all that together, you come up with about 500,000 bars. So I've watched 500,000 bars form one by one by one. And every day I look for patterns and I save them. I categorize them.
When was the last time you added a pattern to your archives?
A section to this?
Well, to any part of your archive, when was the last time you added a pattern that you recognized, i.e. you discovered a new pattern that you hadn't discovered before?
Oh, years ago.
Right. Okay. So years ago, you had essentially everything locked in. You sort of knew exactly what every candle was signifying and giving a signal for, and the probability around that.
Everything's variation on very simple themes. You got breakouts, you got failed breakouts, and you have tests. Tests can be double tops. Tests can be wedge tops. Let me pop that up.
Are you able to give an example of those variations that you've just mentioned? Breakouts, failed breakouts, and tests.
Okay, right here. Okay. You can have double bottoms. You can have triple bottoms. The bottoms are rarely perfect. Here's an example of a perfect triple bottom, right? But there are a lot of variations of triple bottoms. For example, a head and shoulders bottom. The second low is below the first, and the third is above the second. That's basically just 3 attempts to go down. A wedge is 3 attempts to go down. 1, 2, 3, and a reversal up. Head and shoulders bottom is 3 attempts. If you have a double bottom and it breaks to the downside and reverses up, well, that's 3 attempts to go down, reversed up. So, and then if you have a double bottom and an attempt to reverse down and it forms a higher low, it's a double bottom pullback. And that is another variation of that. If you have a triangle, you have either 3 tops or 3 bottoms. Here you got 3 bottoms. If you have an expanding triangle, you have 3 bottoms. So it's all, 3 attempts to go down that fail. The market will usually try to go the other way. Sometimes you'll have a 4th leg or 5th leg, but when you do, it's usually not a wedge with 4 or 5 legs. It's usually, it's usually some other variation. Let me scroll down here. You can see I have lots and lots of examples of wedge bottoms. Okay. Sometimes you get a wedge and the first reversal up doesn't work. You get a new low and you get a second reversal up. So we have an IOI, an inside bar after an outside bar, and you get a second reversal. I actually like this. You have 2 bull bars closing above their midpoints near their highs, and you have a possible wedge bottom. You could buy that, or you could buy that, or you could buy both. But sometimes you get a wedge bottom and it breaks out through the downside and it actually forming a bigger wedge bottom, or you can also look at it as a wedge bottom that failed and reversed up. So all kinds of ways to look at it. You just have to understand what the market is trying to do. When it's selling off, it's trying to get down to support. Every sell-off is a movement down to support. Most support fails. The market keeps going, through one support, through another support, but eventually there'll be a reversal. There'll be profit taking, and it will come at a support. And every rally is a move up to resistance. And most resistance will fail, but at some point, the bulls are going to feel like it's good to take profits, and you get a reversal, or at least a stop. The trend stops going up.
And have you got an example of like where you would get in? If we maybe go back to today's chart,
Today?
and then so where you would get in and where you get out, and staying in the trade. So like, I mean, the rejection at the top of those. Sorry, go on.
This is a 20 bar exponential moving average.
Yeah.
This is a 20 bar exponential moving average from the 60-minute chart. Okay. Right. I wrote an indicator so that this is a very accurate reflection. Here's the 60-minute chart of this. So you can see we broke through it for several hours, and here's the 60-minute moving average. We broke through it for several hours. So on a day like this, I'm going to be buying that, and I'll buy that. I'll definitely sell that. This is probably a minor reversal. It's a lower low double bottom, but this is so surprisingly strong. We have a fairly conspicuous tail here, another fairly conspicuous tail here. We're not quite to a cluster of support. Chances are the rally is going to be minor, and we'll get at least one more leg down, which we did. This is surprisingly big. The first reversal up usually fails. Normally, you're going to get at least a second or third leg down. We got a second and a third. The simplest thing for most traders to do is look for bull. If they're looking to buy, they should look to buy with a stop above a bull bar closing near its high in an area where the context makes good. It makes sense. Here's a gap down to the 60-minute moving average and a very good looking bull bar. So you can buy with a stop one tick above that. Consecutive bull bars, that's good. You can buy with a stop above that. Bears, we have that II in a buy climax. You could sell with a stop below that bear bar. We have a surprisingly big bear bar. And we're not quite to this support. Maybe it'll be a reversal day. You could sell below that. And now we have consecutive bear bars, good sized bodies closing near their lows. This is definitely going to attract a lot of sellers. So as soon as that bar closes, you either sell the market or you put a stop order to sell one tick below the low of that bar. As far as profit taking goes, anybody who says they have a very high winning percentage is scalping, right? It's impossible to have a high winning probability if you're going for swing trades. And the reason for that is risk and reward. There are 3 variables in your trading. There's how much you're risking, how much you're trying to get for profit, and what's the probability. And you cannot have all 3 in your favor. You cannot have very little risk, very big reward, and a very high probability of making that reward. Right? That's like a lottery ticket where you spend $1 and you have a 99% chance of winning $1 million. Right? It's a trade. You give the state money, they give you the ticket. They're not going to trade. They're not going to make that trade. If you get everything, they're not going to make that trade. So there always has to be a reason for somebody to do the opposite of what you're doing. If you want a really high probability of winning, there's theoretically someone who's taking the opposite side of your trade. So if you're getting great probability, they have to have great risk reward. So that means for them, if they're taking a low probability bet, when they win, they have to win a lot relative to their risk. Okay. So if they have great risk reward, you have bad risk reward. So anytime you have a high winning percentage, you're going for a small profit relative to your risk. Okay. And that is why beginners should not take it. It sounds easy to say, I can, the range is 60 points. I can scalp for 1 point and risk 5 points, and I'll win a high percentage of the time. And you are right. You will win a high percentage of the time, but you will not win enough to overcome risking 6 times what you're making. So you will lose money. So scalping is really, really hard, because to do it well, you have to have a very high winning percentage. And what's a high winning percentage? At least 70%. Okay. If you're a really good scalper, you have to win 80 or 90% of the time. I have lots and lots of days when I scalp and I win every trade all day long. I just win every trade. Okay. And that just tells you on those days I'm scalping. I'm going for a small reward. I'm going for a big risk. And most of the time I'm willing to scale in, add to my trade as it goes against me. And that is just really deadly if you're a beginner. So if you're a beginner and you see this, you say, wow, what a strong bull trend. I'm going to show you how beginners get in trouble. Wow, that's one of those buy the close rallies Al's talking about. I got to buy. Another big bull bar. I got to buy. But that's a bigger bar, and it's at the high from a couple of days ago. So that'll attract some profit taking. And then you look at this and say, uh-oh, bear bar. So it's no longer buy the close, it's buy pullbacks. So what I'm going to do, beginner, I'm going to place a limit order to buy 5 points below that bear bar, maybe 10 points below that bear bar. And I'll add on. So I'll buy 5 points down, 10 points down, 15 points down. Okay. And I'll put a stop down here. And then what happens? Okay. You bought here, you bought more 5 points lower. You bought more 5 points lower, and you're thinking you can hold on with a stop down here. You're not going to. You know, your position size suddenly is getting really, really big, and you can see it's a clear sell signal now, and you're long, right? So, beginners, it's just absolutely deadly to be trading with limit orders, especially buying in what is becoming a bear trend or selling in a bull trend, right? It's just deadly to be trading with limit orders and scaling in, because what will happen is you'll give up exactly at the price when you should be adding on. And beginners always trade bigger than what they should be trading, right? I always say trade small. And let me give an example. When I go to a restaurant and I get a hamburger, I'll tell them to put ketchup on it, and I'll tell them to put extra ketchup on it. And they'll say, well, how much is extra? And I said, it's whatever you think, double or triple it, that's extra. Okay. So when I say trade small, it's whatever you think and divide it by, into much, much smaller. So 20%, right? So if you normally trade if you normally trade one E-mini, right? And you're thinking, maybe I should trade this small, trade just 2 micro E-minis. And then you can add on. And if you end up losing, you're not going to lose all that much. And beginners, especially limit order traders scaling in, it's a great way to consistently make money if you know what you're doing. But beginners invariably will trade too big, and you're going to see, and you'll win a high percentage of the time. You might do it well for 70% of the time. And then, you buy this and you buy this and you buy this, and then you get this, and you give back 2 weeks worth of trading, right? And these things don't happen often, but they happen often enough so that you'll lose money. It'll erase so many good trades that, you'll end up losing money, even though you're winning most of the time. You may end up, this may be your one losing trade in the past 6 trades, but it'll be a bigger loss than all of your wins. So beginners should only be trading with stops, which means trading in the direction the market is going. So you buy on a stop above that, right? And you sell on a stop. If you're looking to enter here, the only trade is to sell on a stop below that or buy on a stop above this, and it did not go above, it went down. So beginners should be just stop trading with stop entries.
Yeah, you did it. You actually said that as part of the original interview. You said traders should start out trading stop orders, but most bars on the chart, a stop order is a losing strategy. What did you mean by that?
No. Most bars, I don't know if I said that, I misspoke.
Okay.
Or else I said more.
Or maybe I wrote it down wrong, one or the other.
Okay. Take a look at this. Okay. A stop order trader, he's here. I don't have any indication of whether these are up bars or down bars, but theoretically, a stop order trader, a bull is going to look to buy one tick above that, and a bear is going to look to sell one tick below that. All right. So a bull would buy here, and then he can figure out whatever his scalp is. Scalp, it might be 5% of an average day's range. So he can take his profit here. Now, for the bull to buy here, he's buying from somebody. That means somebody's selling, right? So somebody sold here. And why would somebody sell to the bull? Because that trader is betting that the breakout above this bar is going to fail, and that instead of a bull trend, it's going to be a bull trap, just go up a little bit and go down. So a bear, right? Here are the same two bars here. The bull is buying with a stop, hoping it does that. And somebody is selling to him. The seller is going to be an institution, 95% chance it's an institution, right? And the seller is, if you're buying one tick above that, the seller is selling to you one tick above that. And the seller is hoping that it does not go up very far, and it'll go down far enough for them to make whatever they consider as a reasonable profit. And a skilled limit order trader, if he thinks the context is good and that it will not go up very far, he'll sell more the size of a scalp above his first trade. And then it comes down here. He could get out break even on his first entry and with a scalper's profit on his second entry, or he could hold and get out down here with a scalp profit on this and a bigger profit on that. Right? Always assume that you live in a 40-60 world, right? You can never be more than 40%. You can never be more than 60% certain of the market going up X percent before it goes down X percent. And you can never be more than 60% certain it'll go down X percent before it goes up X percent. Okay? So, and that's true for 95% of the bars in the chart. 10%, 5% of the bars in the chart are like this, and the probability of it going higher is much more than 60%, or like this, and the probability of it going lower is much more than 60%. But most bars in the chart are like this, and the probability of it going up 1 point, 5 points, 10 points is no more than 60%, and the probability of it going down is 40%. So you live in a 40-60 world, always assume that there's a good reason for somebody to do the opposite of what you're doing. So never be absolutely confident that you're right, because at least 40% of the time you're going to be wrong. And if you don't admit to yourself that you're wrong and you hold on to your position, you're going to lose a lot of money. By the way, I talked about this as a buy the close rally and disappointed bears and they disappointed bulls, and they sold out here. Well, this is a sell the close rally, right? Sell the close bear trend. And if you're a bear, what happens if you see that? You're thinking, that's pretty disappointing. Maybe it's no longer going to be, maybe it's going to enter a trading range. So a lot of the bears who sold here, when they see that, will buy back their shorts here. And you can see it stalled for 4 bars. Same with right here. A surprisingly big sell-off, you're probably going to get at least a small second leg sideways to down. But if you see that, you're concerned, especially when it's a third leg down, you're concerned that it may not go much further down. And a lot of the bears who sold that close were disappointed by this, and they get out around break even here, and that caused that. Another thing is a wedge bottom.
So can I just ask a quick question before I forget? So we're really at the end of the next bar, people are thinking, they're only going to give it 1 bar to work, right? They're not going to sit there for 4 or 5 bars and go, fingers crossed, this thing's going to turn around. They're literally, as soon as it doesn't work, they're like, I'm out. Is that the sort of
very
general
strong
premise?
There are 2 types of trends, all right? The buy the close trends and 2 types of bull trends. buy the close and buy pullbacks. Okay.
Yep.
And buy the close means you're willing to buy at the high as it's going up. At some point, the market does something to make you think, maybe it's not a buy the close trend anymore. And therefore, I got to trade it differently. All right. So when you see that, you stop buying at the high, you start looking to buy pullbacks. And here, instead of a pullback, you get a reversal. And the same down here. It's clearly sell the market, sell for any reason, sell the close, and then something happens. It changes. Okay. When you see that, traders who were selling the close buy back their shorts and they look for a rally to sell a pullback. Okay. So that bull bar and a really strong bear trend is a sign that maybe it's no longer good to sell at the low. Maybe it's better to sell a rally.
One of the things you did mention was that, new traders tend to have their stops too tight. And I know that you said that, in the example you gave in the show, you had a stop of like 100 pips when price had rallied 100 pips. And you were happy to just take, you knew you were potentially on for another 100, but you were happy with a lower risk to reward. And if price dropped 20, you're happy with 20, or retrace 20, you're happy with 20. So in this scenario here, that first trade, where would you have had your stop? And where do you think a new trader would have had their stop?
Okay, look, let's say I buy this. Most traders, if they're buying it, they're looking for a swing up, betting it's the low of the day. So if they buy that, they put their stop at the most recent low. They put it here.
Yep.
Right. And they swing up until something happens. And here they would get out. They get out below that bear bar. And if they're able to, they reverse to short. And if a bear sold here, this is a special case. In any case, you put a stop above the most recent high. It's also an II. You don't want the market to go above the top of the higher of the two bars. So you can get out one tick above that, but it's almost here. I would just put my stop above there. So most traders, if they're entering with stops, they should put their protective stop beyond the most recent swing point. So if you buy, here's a high two attempts up. It went above this, failed, went above this, and the bulls could have made a 10-point scalp. So if you bought on a stop above this bull bar and got filled here, and you placed a limit order to get out with 10 points, you probably would have made it here, and you would have put your stop here. Had I bought this, after this, I'm looking for a minor rally. A minor rally means it becomes a bear flag or it becomes a trading range. I'm not going to swing this, all right, especially after we've had one big leg up, one big leg down. It's really unlikely that we're going to go straight up again. So I'm looking for a minor move. It's a high probability move that we're going to bounce, probably to around the moving average. So I'm looking for a minor move. The bars are still big. So instead of a 5-point scalp, which I'll do when the bars look like this, smaller bars, if the average bar is, 5 points, 3 points, 8 points, I'll scalp for 5 points. But if the average bar is, 10 points, 20 points, my scalps are 10 points. So for this, if I buy above that, I'll put a stop down here, and I'm risking, 15 points to make 10 points, a test to the moving average. It's a high probability buy. So that automatically tells you your risk is going to be greater than your reward. And it is. If you buy on a stop above this, you put your stop below that, you're risking 15 to make 10.
And do you ever get out for partial, or would you just always exit fully or in the majority of your position?
A lot of times, depends on what I'm doing. If I'm scalping, I'm looking for a quick move, and it makes my move, boom, I'm out. Right? I don't hope that I never hope a scalp turns into a swing, but I'm always prepared that a swing will turn into a scalp. Okay. So
right,
if I take a trade and I'm entering, betting it's a scalp, I'm going to get out as a scalp. Right. I don't care if it ultimately becomes a swing. If it does, I can buy again. Right. So if I buy this and it just keeps going up, if it starts to do this and I took profits here, I'll buy again. Right. But if you're taking a scalp, you're looking for a quick move. You're not looking for a trend. You're looking for a quick move. I get the move, I'm out. And I don't care if it keeps going up. I'll buy more, right? If I'm swing trading and I become disappointed I'll turn it into a scalp, or even get out with a loss and not let my stop get hit. So if I take a swing, what I think is a swing trade, and it does something that it should not be doing, then my premise is no longer right. I'm going to get out.
And where do you think a retail trader is putting their stop and getting it wrong in these scenarios?
Okay, I'll show you one thing a retail trader will do. Okay, he buys above this, right? And initially the stop is here, and then he sees that tail, and he's going to say, oh my gosh, I don't want to risk 15, 20 points. I'm going to do this. I'm going to risk less. I'll put up a 1 minute chart. So he puts up a 1 minute chart, and he sees this bear bar, and he sees it's a wedge on the 1 minute chart. 1, 2, 3, 4. I better get out. Right. So he did a sensible thing. He bought above that bar, and he gets out on the 5 minute chart. And he gets out below this, and then he misses all that. Or if he does buy, he sees a bar, a second bear bar. He gets out. So one of the big mistakes that beginners make is entering on one time frame and exiting on a smaller time frame. Okay, thinking that they're going to reduce risk, right? But when they reduce risk, they're also greatly reducing the probability of winning. So, they had a potential for a big reward, and they're turning it into, they're basically turning it into a scalp. And whenever traders do that, beginners, they're going to lose. And if they take the trade and you get that tail and they think, oh my God, I got to get out, I can't risk that much, that tells you immediately that they're trading too large, right? So if they trade one E-mini, and once it goes here and it's, oh my gosh, 15 points, I can't risk that $750. I can't, I have a $5,000 account. I can't risk $750, right? That means they're trading too big. So if ever a trader enters a trade and shortly after they get in, they start to feel really anxious that the risk is much greater than they want it to be, that's their radar telling them that they're trading too big, right? Until a trader is consistently profitable, they should trade the smallest possible position size. Let's say you have a $1 million account and you come to me and say, Al, I could trade 100 E-minis. What size should I trade? I would tell them trade 1 micro E-mini, because you're going to lose when you start out. And what you're trying to do is first stop losing, and then consistently winning, and then build your account, and then start to increase your position size, right? So you should trade, anybody who's losing should be trading the absolute smallest position size, no matter what their account size is. So if a person is not consistently winning, they should be trading 1 micro E-mini, right? Or 10,000 units of the euro versus the dollar. They should be trading very, very small. And how long should they do it? Until they consistently win. I know the argument, you say, well, Al, if I only trade 1 micro E-mini, I'm not going to get rich, and I want to get rich, right? But that's thinking about it wrong. Your first goal is not, I got to get rich. That's a goal way down the line. First goal is, I got to stop losing money. I got to learn how to consistently make money. I have to grow my account, and then I'll gradually increase my position size. And then I can think about getting rich. And, that process takes a long time, a year, 2, 3 years. It takes a long time to get up to a position size where, in fact, you can get rich. And, what's rich? Nobody's rich. Anybody has $1 more than you is rich. But if you're trading 1 E-mini and you're making that 1 swing trade a day, 20-point swing trade a day, that's $1,000. And times 200 days a year, that's $200,000. That's not rich, but it's decent. And if you can increase your position size to 10 contracts, you're making $2 million a year. And all of a sudden you're thinking, I'm probably rich, right? But it takes time to go from 1 E-mini, 1 micro E-mini, to 10 regular size E-minis. And don't rush it. The 10 is the dream, Don't give up the dream, but you have steps to go along the way. Learn how to trade properly, learn how to read charts, learn where to put your stops, and discipline, right? I'm saying beginners should only be trading with stops, and they should only be swing trading, and they should use appropriate protective stops, knowing that they're only going to win maybe 40% of the time, right? But as long as their risk is not too big, as long as the reward, a swing trade, the reward is probably on average at least twice as big as their risk. Okay. And if you do the math, if you're betting $1 of risk to make $2, and even if you win only 40% of the time, you're not going to lose money. Right.
Yeah.
So a swing trade, if you take reasonable setups, there's a 40% chance you're going to make twice your risk, right? And if you get good, instead of making twice your risk, you might make 3 or 4 times your risk. And instead of winning, 30 or 40% of the time, you may find that you're winning 50% of the time. And all of a sudden, the math starts to get really, really good. But a swing trader, when they look at a chart like this, they buy here or here, they put a stop down here, they trade small, and they hold on until they get that, and then they get out. And if they're flat going into this and they see this and they say, oh, that's one of Al's patterns, a buy climax with an II, I'm going to sell below that bear bar closing near its low. And I'll put my stop up here and I'll place a limit order, maybe to get out of my position at twice my risk or 3 times your risk. In this case, you would have made 3 or 4 times your risk, right? Another problem beginners have is, they lose. And if they lose 3 times in a row, the next trade, they think they're going to swing trade, and it goes up the size of a scalp or down the size of a scalp, and they just take the scalp and say, I really needed a win, right? and that's okay. It's okay to do that, but you can't do that all the time. At some point, you got to start swing trading. And if you find that you're doing it all the time, what you do is you do the Walmart strategy, okay? I learned this from a buddy of mine, and about 20 years ago, I was trading online with this older guy. He was my age, at the time. And he would trade and find a swing trade, usually in the first hour or two, put the trade on, put a protective stop in, and place a profit-taking limit order in, right? So he'd be trying to get out with at least twice his risk. And he would go take his mother to the doctor for a couple hours. Or he'd go row his boat for a couple hours, or he'd go to Walmart. And, that's why I call it the Walmart strategy.
Yeah. So
if you're taking profits too quickly and you have a reasonable setup and you are familiar with patterns, I keep talking about encyclopedia of patterns, I every day I look for patterns and I study them. Every day I take a chart, and then I do this to it.
Wow.
Okay. I look for every pattern.
Yeah.
And I try to understand what's going on. Right. And that's my practice. Here's a chart. And then I do that to it.
Wow.
Okay. I look for every possible way to draw a wedge, every possible double top. Here's a higher high double top. Here's a lower high double top. Here's a higher high double top compared to that. Here's a double top and wedge. I look for every pattern. I look for all the signal bars, and and that's my practice. If you're a great rugby player and you play on whatever Saturday, all right, let's say you're a professional, you're practicing all the other days, right? And because you want to stay fresh. American football players, they practice all day, every day. And they play for a couple hours on the weekend. Basketball players, everybody's, professionals practice, and I practice. So now when I see stuff happening during the day, I see almost everything as it's happening, and I see almost everything before it happens. I see stuff as it's unfolding, so I can anticipate, and so it's just natural to me. So when I see stuff happening, it's very easy to to place the trades. So it's really important. If you're trading price action, it's really important to learn patterns and then learn all the variations of the patterns. You can let me show you something as an example.
And I'm guessing this is how you manage to keep on top of, as soon as you see it, you know it because you've just embedded it in your mind over the years by doing this practice.
Yeah, I do it all, every day. Here I am, 71 years old, and every day I do it. Okay, so on the open, this is a gap up. Here's the moving average, a gap up, and I'm looking for 3 legs down. A series of bear bars, that's a leg. You got a bull bar, so that's 1 leg. A couple more bear bars and then a bull bar, that's a 2nd leg. All right. I'm looking for a reversal up from a wedge. On the open, if you have a big gap up, the market usually tries to get near the moving average and then reverse up from some kind of a wedge or a double bottom. So you can either buy above that, or you could wait for a bull bar closing near its high and then buy above that and go for a swing, twice your risk. So wedges, they can be small like that. They can be bigger like that. A lot of times they don't even look like wedges. Here we got 3 lows. We were down, then up and down and up and down. So that's a wedge. If you don't want to buy above that, you can wait for a bull bar closing near its high and then buy on a stop above that. So lots of variations. Sometimes there's more than one way to look at a wedge. We have a low, a second low, a third low. This is a wedge. And you can view this as a truncated wedge where the 3rd leg did not go below the 2nd. So it's a wedge that got cut off. So you just got to be open to everything and, accept that nothing is perfect. If you do a Google search for wedge bottoms, you'll find perfect looking wedge bottoms, right? If you're trading wedge bottoms in the real world, you're not going to see those perfect ones. How do I know that? Because I've looked for perfect ones to put in books or in articles, and I have to look at a whole bunch of stuff to get a perfect thing. Yeah. Most things aren't perfect. Most things, they look like that, or they look like that, or they look like that, right? The perfect ones are really rare, right? So you don't worry about perfect patterns. What you have to be able to do is understand, 3 legs down, 1 and a bull bar, 2 and a bull bar, 3, a bull bar at the moving average. After a gap up, it's a buy. If you want, you can wait for consecutive bull bars. That's a buy. So
it looks like you use a lot of stop orders now. How often do you use limit orders to get into a trade?
It depends. So I'll give you an example. On a trading range day, I'm not looking for swings, right? On a trading range day, I'm looking for reversals. And there are different ways to look for reversals. One is market sells off and you buy with a stop above the high of a bar. Let me see if I have a better example of what I'm looking for. Okay. You see lots of overlapping bars, 3 or 4 bars overlapping here, very prominent tails, lots of reversals, bull, bear, bull, bear, bull, bear, right? New low, reversed up twice. It's probably a trading range day. In a trading range day, I'm much more likely to take a lot of limit order trades. And obviously, if it's near the low and reversing up, I'll buy with the stop for a scalp. If it's near the high and reversing down, especially the second signal, 1, 2, I'll sell with the stop. Okay. But beyond that, what I'll do is anytime the market does something bearish near the low, I'm going to buy at the market. If I see a big bear bar near the low, I'm going to buy the market on the close of that bar. Another one, I'll buy the market and I'll look for a scalp. And anything bullish, I'm going to sell anything bullish in the top third of the day. Big bull bar, I'm going to sell it. Okay. Big bull bar breaking out, it's going to fail. I'm going to sell it. Big bull bar breaking out, I'm going to sell the close of that bar. I'm going to sell the market. Okay. Betting on a reversal. If it's a second bar, I'll get out. Right. But if it does this, I'll sell below that. Okay. Another thing I'll do is anytime it goes above a prior high, I'll sell. Goes above this high, I'll sell for a scalp. Goes above this high, I'll place a limit order to sell, and I'll sell for a scalp. I'll place limit orders to buy at prior lows. I'll see it rally here. I'll place a limit order to buy. If it goes below that, I'll get filled. It rallies. I'll place a limit order to buy at that low. I'll get filled. Okay. Here's a high. I'm going to place a limit order to sell at that high for a scalp.
It's interesting because I was just thinking, like you don't tend to with what you're doing and what you've shown today, it doesn't seem like you're looking left much to see what things, what's going to hit, what price is going to hit. That's sitting over in the left of the chart. Is that right? Am I right to think that? Or
I'm sorry, what you said the lift?
Left. Sorry, that's my accent. Left as in right, left and right. So looking sort of in the past on the chart.
Once I think, see, this is just today. I don't care what's taking place over there.
Yeah.
Yesterday, I do to an extent, right?
Yeah. With your,
for example,
time frame stuff.
This red line is yesterday's low. This red line is yesterday's high.
Yeah.
And so and here's a high from last week. Right. So I do pay attention to the left, but the further things are from the left, the less the computers pay attention to them. So on a 5-minute chart, the more bars to the left, the less important it is. The most important bar on any chart is the bar right before the current one. All right. Are there going to be more buyers or sellers above that bar? Are there going to be more buyers or sellers below that bar? That is the most important bar in the chart, the most important support and resistance.
So how do you determine that? Like one of the things you mentioned in the first interview was the transition between phases. So like it's going from a trending phase, transitioning into a range. And one of the things you said was, if it's transitioning and you don't know if it's a range or a wedge or whatever, it's a range. Is that still your way to determine that it's a range? And do you change your style to go to the more of that limit order, enter at market against strong bulls, bears at the edge of the range style?
If I see 3 or 4 bull bars in a row, right, and the tails are not too conspicuous, and there's not much overlap between the bodies, the market's probably trending. If I see reversals every 1, 2, or 3 bars, and the bodies are overlapping and the tails are prominent, it's probably going sideways. It's probably a limit order market. So this looks like the start of a limit order market. So, and here I'm limit order trading, right? Here I'm stop order trading or buying at the market. Here I'm stop order selling or I'm selling at the market. But once you start to get bars that are overlapping and you get smaller bodies, bigger tails, and lots of reversals, it's limit order trading. Most traders, when they see this, should just stop trading and then just wait for bigger patterns like a wedge, 3 legs down, 1, 2, 3, and then buy that. And be disappointed that this is not bigger and switch to a scalp. So if you bought this for a swing and you're starting to see entry bars that are not too big, tail pretty conspicuous, stalling in the middle of the trading range, and you bought that, I would switch to a scalp.
And
I'm going to scalp this anyway because chances are it's going to remain a trading range. The market has inertia. Go ahead.
That fifth bar from the open, 1, 2, 3, 4, 5, where it's an inside bull bar with equal size wicks on either side. I mean, what's this? How do you see that bar, and what's keeping you in that long trade? Because it sort of looks about like it could be the start of a trading range.
Okay. Yes, the prominent tails. There was some stalling here, below yesterday's high, below yesterday's close. But what do we have? We have a reasonable buy. We have consecutive bull bars with at least one being big and closing near its high. So that's a buy the close market. And it remains by the close until you get something that tells you it's not by the close. All right. So once you start getting bear bars, traders become less willing to buy closes. But anytime there's a bull bar, traders are going to buy the close. And take a look at what took place here.
Yeah, exactly.
Okay. I want to show you something. Okay. When you have a big tail on top, traders are less willing to buy with a stop above the tail, but it's still by the close. So they're more willing to buy as soon as the bar closes. So as soon as that bar closed with the bull body, a whole bunch of orders came in by the market. And look at the open of the next bar.
Gaps
okay.
Up.
It's up. It gapped up. There's a small gap there. Another gap here. All right. Another gap here. What does that tell you? It tells you as soon as the bar is closing, what's happening. a whole bunch of orders are going in there by the market, right? So you know it's by the close. It's still by the close here. But then you get this, and traders are saying that, okay, something's changed. It's no longer by the close, and therefore my by the close trade, it's probably too risky now, so I'm going to try to get out if it allows me to get out. And that's why you got that reversal right there.
And when you're buying the close of all these bars, like if you were starting out, thinking, oh, I'm going to try this, are you still keeping your stop at the original stop point and just having, a much wider stop with a less risk to reward?
Okay. Listen to what I'm going to say here. I talk about this in the chat room all the time. Okay. Theoretically, if you bought this close, here's your stop. And you'd be an idiot if you're a day trader and you risk that much. And since you can't be an idiot and make money, you have to have plan B. Okay. And plan B is one of these two things. If you're long and you get a bear bar closing below its midpoint, you get out on a stop below that bear bar. Okay. If you're long and you don't have a bear bar closing near its low, you get out below the prior bar, the size of a scalp. So if a scalp is 5 points, you get out 5 points below any bar, bull or bear. Okay. And then if the market keeps going your way, you can always go get back in. For example, here. Okay. By the close rally, bear bar. Okay. You don't have, this is a small pullback bull trend. Chances are it's going to last at least a couple hours. You don't have to get out below that small bear bar. But if you did, you get out. But if you want to swing trade, and you got to get long again. And how do you get long again? I have two ways to get long again. Okay. One is if you get a bull bar closing near its high, you buy again here. The other is if it makes a new high. So if you get out below this, you place a stop to buy one tick above the prior high. You get long there. And that's what caused that breakout. Okay. Here's an example. Oh, this didn't fall far enough for a scalp, but this one did. Okay. So let's say you bought the close. This is no longer buy the close. It's looking like a trading range since bar 18. But if you did buy that and you did not want to risk to down here, you could get out the size of a scalp below that. And a scalp is 5 points. These lines are 5 points apart. You can get out 5 points below that. You can get out here, or you can get out below a bear bar closing near its low here, or you can get out below two bear bars here. All right. And then just wait for a bull bar closing near its high and you buy again. You buy again here. Okay. This is no longer a buy the close trend. We're starting to go sideways, we're getting a lot of pullback, a lot of overlap, but this is a buy the close bull trend. But I would still trade it the same, right? If you're long, get out the size of a scalp below any bar, and or get out below a bear bar closing near its low, or certainly near its low, but at least below its midpoint. And why am I saying get out below the size of a scalp? Why do you think I said that?
Because it's likely to be, everyone else is likely to be doing a scalp as well. There'll be a lot of scalpers doing it.
Listen to this, okay? Yeah. In a strong bear trend, can the bears make money selling on stops? No. Maybe make a little bit, probably not, right? Yeah. In a strong bear trend, bears cannot make money with stops. In a really strong bear trend, bears cannot make money even with limit orders. Okay. So let's say a bear sold the high of this bar and then sold more 5 points higher. He's trying to get out at this high. It has to go one tick below this high. Market reverses, but there's a gap. This low, that high. So the limit order bear got screwed. He buys back his short with a loss. He tries it again here. Places the limit order to sell here, hoping it'll fall 5 points, the scalp. Okay. Instead, it does this and reverses. It does not allow him to get out, break even. So he can't get out without a loss. He buys back his short here. All right. So if you look at a chart and if you look at a bull chart and limit order bears cannot make money, that's a really, really strong bear trend. Right. Limit order bears cannot make money. Stop order bears, if a limit order bear cannot make money, a stop order bear cannot make money because he's selling even further down and he needs it to go even lower. So I always pay attention. If limit order bears cannot make money, do not sell. Yesterday in the chat room, when this was happening, I pointed that out. I said, you're getting these gaps and limit order bears, they're getting screwed. You cannot sell. You can only buy. It's a really strong bull trend. And then when we got this, I said, I bet the market is starting to be a trading range. It'll probably go higher, but it's probably the start of a trading range. And it was a trading range for the remainder of the day. I don't want to be selling until I see limit order bears make money, and preferably until I see stop order bears make money. Okay? If bears can make money with a stop, the market has to fall further than with the limit order. Limit order is selling at the high. And if you're selling with a stop, you're selling below the high. Right? So once stop order bears are starting to make money, right, the market is definitely changing. It's definitely less strong, and it's becoming two-sided. It might be entering a trading range. And that's why I'm saying that if the market falls to the size of a stop below any bar, then stop order bears are starting to make money. And it's no longer a very strong trend. It might be becoming a trading range. So I get out, as a fail-safe. Anytime the market goes the size of a scalp in the wrong direction, I get out. If it goes back into my direction, I can always enter again. Right? But I'm not going to risk. I'm not going to buy here and risk there. And if I bought here and held long here, that's not somebody else's money. That's my money. If I look at my account, that's my money. Right? So I'm going to treat it like it's my money. And I'm not going to put my stop down here. I'm going to get out the size of the scalp below any bar, and I'll get out one tick below a bear bar closing below its midpoint. Does that make sense?
Yeah. So you're getting out the size of a scalp below any bar, right? That makes perfect sense.
Worst case. Worst case.
And it's interesting you say that. I mean, it is a very unique way to, I suppose, give you confidence to stay in your trade, because if you're looking at the other side, the stop order bears and the limit order bears, if they're not making money, stay in your trade, and then wait until they are making money before you reverse your direction, which is another good little lesson there. Instead of, I think a lot of people just use market structure, which you haven't really even touched on to a certain degree at all, and I don't even know if you use that in your trading. Do you?
Say market structure.
Market structure isn't like a higher high and a lower low, and
I do that all the time. You're talking about patterns like head and shoulders tops and higher high major trend reversals, lower high. I trade that stuff all the time. Okay, I pay a lot of attention to it. Here you could call this a lower low double bottom. You can call this a wedge bottom. Wedge bottom is just another lower low, and it's the second consecutive lower low. So I pay a lot of attention to wedges and double bottoms, double tops. I pay attention to that. Constantly. Micro double tops. I told you, an II is always a micro double top, and it's usually also a small triangle. So there's a micro double top. So I'm going to be selling below that neckline, which is that bar 10 low.
Awesome. This has been absolutely fascinating, Al, and over exceeded my expectations in terms of what you were going to share with us today based on the interview that we did 6 years ago. And I know that a lot of people would have taken away a ton of stuff here, and we could probably go on for hours, I'm guessing. But you obviously have a course and stuff, so you in a program which you do let your members into all the other secrets. So I'm going to stop you sharing here. Tired of missing trades or spending hours at the charts? Introducing my Robot Builders Club. With our platform, you can build bots in minutes, not weeks, without any coding required. Get lifetime access to my video course, VIP community, and over 40 ready-made robots. Works with MT4 or MT5, and as a bonus, you'll get 3 months access to my robot lab, where we build and test bots on live calls every week. Join the hundreds of traders who are trading smarter, not harder. Click the link in the description to learn more, get the free training, and download a free robot. And we're going to wrap this baby up because it has been absolutely awesome. So Al, once again, thank you for coming on. What's the best way for people to get hold of you and find out more?
Well, the easiest thing is one of my websites. On the bottom of all my slides, I have down here, brookstradingcourse.com. And that's the easiest way to get more information. You can just Google search Brooks trading course, and my material is there.
Cool. Well, what we'll do is we'll flick that up on the screen here whilst you were mentioning it. And folks, if you do want to check out that podcast we did shoot like 6 years ago, still packed full of value. We put a link below the video to all of our stuff and the links to his course and everything there. Al, thank you once again for coming on. Guys, whilst you're clicking around down there, hit subscribe, hit like, click on that notifications bell, and we'll see you in the next video.